morning. Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking a little bit about fundamentally speaking today in regards to earnings. With the majority of earnings in for the third quarter of 2019, we can now take a look at how earnings actually came in from a variety of different angles. First, the good news is that 73% of companies beat estimates. That's amazing, right? That's one of the highest beat rates that we've had over the last couple of years, and that's because companies are beating their estimates, and that's a good thing, right? That's why markets are up. Well, the not so good news is in order for those estimates to be beat, we had to dramatically lower those estimates in order for the companies to actually beat them. This is why I call it millennial soccer. Everybody gets a trophy just for participating. Outside of this, importantly, look, earnings have not grown here over the last year. Since September of 2018, earnings are actually lower by 3 and 5% between operating and reported earnings, but yet the stock market is up over 7% in that same time frame. Investors are paying more than what they're actually getting in underlying earnings. One of the drivers for companies to actually beat their estimates is by lowering the denominator of the calculation of price and earnings. And this is one of the things that have been driven by corporate stock buybacks. Corporate stock buybacks have surged over the last couple of years because of tax cuts. That's lowered the number of shares outstanding by about 20%. And that's increased the ability for companies to actually beat these estimates, right? So we're lowering the number of shares outstanding. And this really shows up when you look at reported earnings per share as by the outstanding shares that are going. This has actually increased earnings per share by about $3 a share. And you can really see this by reported EPS has grown by 357%. But see, that's what happens at the bottom line. At the top line where revenue occurs, that's only grown by 62% since 2009. So in other words, taking $1 of revenue and making it a lot bigger in terms of reported earnings per share by reducing outstanding shares. This creates an illusion of profitability, but not really profitability itself. And this comes back to the old saying of basically, what are you paying for? These are the estimates going out into 2020 as of April of this year. April of 2019 was when they first produced the 2020 estimates for next year. At that time, when these were issued out, there was $174 by the end of 2020. Today, that estimate has already fallen to $163, more than $11 decline just since April and what is expected for 2020 earnings. These estimates are still too high. They're going to have to come down further, and this is going to apply more pressure to basically prices and markets as these earnings are reduced. Currently, investors are paying way too much for what they're getting in terms of corporate profits, which is actually what's reported. And these deviations in price over profits are generally only seen near market peaks. So again, the important thing here is be careful what you pay for, because ultimately what the price you pay is the value that you get down the road. And currently right now, investors are paying way too much for the earnings that they're getting. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. You can get this report and more at our website, realinvestmentadvice.com, along with all of our podcasts, YouTubes, and our YouTube today is with Thomas Thornton from Hedge Fund Telemetry on the website today, realinvestmentadvice.com. Have a great day.